Continuing with topic 5 of paper 3, covering record keeping and contracts, limits and reporting, we now move to paragraph 2.3 on page 5.6, and this is part of the contracts note statement and receipt rules. And this covers daily statements of account. Now, this is very relevant for paper 3 because daily statements of account are issued whenever margin is involved, either trading on the margin or providing securities margin financing. And the world of futures is all to do with posting margins. So daily statements of account are very relevant. And as it says at the beginning of para 2.3, daily statement must be prepared by intermediaries providing securities margin finance and their associate entities when client assets are deposited or withdrawn. But it's the second point that is of major relevance to paper 3, by intermediaries conducting margin transactions such as futures contracts, both when the margin transaction is entered into and when it is closed. In each of those events, a daily statement must be issued. Must be issued to the client no later than the end of the second business day. That's T+2 after the specified event. And what should it include? Well, as with contract notes, daily statement of account contents can be examined. And it lists there that it should include the intermediary's company name of any associate entity that's holding the client assets, the client name, address, account number, date when the statement's prepared, which is fairly obvious, information for that day. Remember, it's a day that's being covered, including opening, closing balances, details of day's movements, and on it goes. I'll let you read the detail. As with contract notes, do I need to know all this information for going to exam? There is a chance that it could be examined. Contract note contents are more commonly examined, but daily statement of account contents could be. I'd be aware of it without memorizing it inside out. 2.4, monthly statement of account. This must be prepared for all clients. It will contain information broadly similar to that of the daily statement, but it should also include details of all contracts entered into for the client during the month, outstanding balance at the beginning and the end of the month, and all open positions held at the end of the month. As we've seen earlier, the monthly statement must be issued within 7 business days. Daily statement, 2 business days. Monthly statement, 7 business days. And last point at page 5.6, no statement is needed, no monthly statement, when activity during the month and no balances at the end of, when there's no activity, I should say, during the month, and no balance at the end of the month. In other words, if you've got opening balance 0, no activity, and closing balance 0, no need to issue a monthly statement. And then we've got details on receipts. They must be issued by an intermediary or an associate entity when they receive client asset security by the end of the second business day, T+2. Now, there are situations where no receipt is required. This is not commonly examined, but I have seen a question pop up every now and then. So it's where someone else has to issue the receipt. So client money deposited directly by the client into a bank, well, it's the bank that issues the receipts. Securities deposited with the intermediary's custodian, it's the custodian that issues the receipts. Contract note includes required information is stated to serve as a receipt, then the receipt itself is not required. Other related requirements with the contract note rules: only the client or person independent of the intermediary designated by the client writer can receive the documents. So employees or officers of the licensed corporation not allowed to receive the documents, no hold mail accounts. And reporting of non-compliance and penalties is the same as with other rules that we have covered. Now we move on to the third and the last section for topic 5, and this is relatively new material, can be examined, fairly detailed. So I'm going to go over it in a certain amount of detail and highlight some points. If we understand the underlying reasons for this legislation, it makes the questions that much easier. So we're looking at the Securities and Futures Contracts Limits and Reportable Positions Rules. So we're going to see with regard to futures and options that any person developing a position in either futures and or options, there will be a limit where they must start reporting their position to the futures exchange and or the securities exchange, stock exchange, I should say. And there are also position limits where they can go no further, but there is some exceptions. Let's look at the background. These rules seek to discourage the large buildup of derivative positions that could adversely affect the orderly functioning of the market. That's the point of them. The rules apply to futures contracts and stock option contracts listed in the rules schedules. I wouldn't worry about that. We don't need to know the individual futures and options. And traded through the futures exchange. Remember, futures and options on futures are traded through the futures exchange, while options on securities are traded through the stock exchange. Now, these rules operate by specifying, and this is what I introduced, reportable positions, being aggregate number of open positions in futures or stock option contracts that have reached a certain level. Once you hit that level, you must start reporting to the relevant exchange. And secondly, prescribed limits, and that's limits on the number of futures or option contracts that you are permitted to hold. Now, who do these rules apply to? They apply to any person who holds a relevant position in futures or stock options contracts, whether or not the person is licensed by or registered with the SFC. In other words, they apply to individual investors or particular clients of intermediaries. It's not the intermediary itself. It's a lot more granular than that. SFC's issued guidance note and position limits in large open positions. Remember, guidelines do not have the force of law, whereas the rules do, and that's the point that's being made. Next, the rules have the force of law, and breaching them as a criminal offence can result in the imposition of a fine up to 100,000 Hong Kong dollars and imprisonment for up to 2 years. So there you are. The rules have some teeth. On the other hand, the guidelines that the SFC has issued on this material, they do not have the force of law. They're there to inform market participants of the SFC's intent with regard to these rules. What happens where the position is held or controlled for another party? For example, a parent holding for subsidiary, the parent company would not be regarded as controlling any future or stock option contract owned by its subsidiary. That's the point I'm making, not the parents. It's where the subsidiary holds the futures or options positions. The parent is not accountable. Okay, let's look paragraph 3.3 on reportable positions. Person holding or controlling a reportable position must report to who? To the futures exchange or to the stock exchange, depending whether it's a future or an option on a stock. Report must be made in writing within 1 business day of there being a reportable position, and each day thereafter until you go below the reportable position. The report, and that's what the next point says, reporting obligation will only cease once the position is reduced to below the reporting level. Person holding or controlling a report position may also appoint an agent to make a report on its behalf. Continuing. Top of page 5.9. The report must contain details of the futures or the stock options contracts held and the identity of any person that holds or controls the futures stock options. So they want to know when certain holdings get to particular levels, they want them reported and they want to know who is holding those positions. So that was reportable. Now we look at prescribed limits. You cannot go beyond these limits unless you're authorized, and we'll consider that in a moment. All futures or stock option contracts subject to this reporting requirement, also subject to prescribed limits or position limits. They will be higher, obviously, than the reportable position. And we're given in the notes 3 examples. If you're holding or controlling a stock futures contract on shares listed on the stock exchange, then the reportable level is 1,000 open contracts for any one contract month, and the prescribed position limit is 5,000 open contracts. So 1,000 open contracts for the contract month. Then you must, once you go beyond that, you must report. and you cannot go beyond 5,000 open contracts. Next example is with regard to Hang Seng Index Volatility Index future contracts. There, again, the reporting position is 1,000 open contracts for any particular month, and the prescribed position limit that you cannot go beyond 10,000 open contracts. So the shares listed on the stock exchange, it's 1,000, 5,000, where it's volatility index futures, it's 1,000, 10,000. And then with regard to gold futures contracts, the reporting obligation is 500 open contracts, but there is no prescribed position limit. So that's an easy one to remember. Gold with futures, you can go as high as you want. There is no prescribed position limit. But if you hold a position in excess of the position limits that are prescribed, you're breaking the law. And unless you've been given authorization, you can be prosecuted. Now, authorization to go beyond the prescribed limits can be given by futures exchange, stock exchange, or the SFC. Now, authorization by the futures exchange and stock exchange to enable you to exceed the prescribed limits are where market makers or liquidity providers are involved, or certain issues of structured products listed in the stock exchange who hold or control future stock option contracts. Right, and those are held for hedging risks. So we can go beyond the prescribed limits if we obtain authorization by the futures exchange or the stock exchange. You can also get authorization to exceed the prescribed position limits from the SFC. And they will do it in 4 circumstances. And those 4 circumstances are listed. I'll let you read them through. The 4th is in special circumstance. So that's sort of a catch-all. Finishing off the points with regard to 3.6, in each case that was highlighted, SFC must be satisfied that authorizing the excess would not be prejudicial to the interest of the investing public. It's the integrity of the market, that type of thing. SFC will also consider whether granting any authorization would be inconsistent with the statutory regulatory objectives in the SFO. Any authorization given must specify the maximum amount by which the prescribed limit may be exceeded. So yes, you can exceed, but then they will give you the excess beyond which you cannot go. The SFC also has the power to vary or withdraw the terms of the authorization, at least 5 business days written notice giving, 5 business days written notice. SFC may not authorize an amount in excess of 300%. So there is a position limit on the exemption of the position limit. You can go beyond it, but not beyond 300% of the position limit prescribed in the rules. And any SFC decision that's made with regard to authorizations, if you wish to appeal it, it can be made to the Securities and Futures Appeals Tribunal. Now, as I said at the beginning of the lecture on topic 5, there's not that much material. There's 3 sections, and I reckon there'll be around about 7 questions. So you're going to get probably 2 or 3 questions from the first 2 and 1 question from the last section on the reportable and prescribed limits with regard to futures and options. So it's a good use of your time to read through this material, do the practice questions on Examinator.online, and you should be in good shape for the exam.